Okay, class. Now we are from the fourth group. We're going to present about the net present value and other investment criteria. Our group consists of Aisha Rizky Paramitha, Asri Muliani, Salwa Athaya, Hanif alhaidar, ardhita arga leva, taracella fathia, Ricky devito valerian, and Timothy Putra Anugrah. Now, our outline, we're gonna discuss about the net present value, the payback rule, the discounted payback, the average accounting return, with the problem question number 4 and number 17 ABC.
Good afternoon, ma'am and friends. My name is taracella and I would like to present the net present value. The definition of net present value is the difference between an investment's market value and its cost. In other words, net present value is a measure of how much value is created or added today by undertaking an investment. For example, the firm buy a rundown house for $25,000 and spent another $25,000 to get it fixed up. And then the total investment become $50,000. Then the house worth $60,000. The market value exceeds the cost by $10,000. So the net present value is $10,000. And then there is a capital budgeting process. The capital budgeting process viewed as a search for investment with a positive net present value. And the step to making the capital budgeting decision is the first one is look at what comparable fixed-up properties were selling for in the market. And the second is get the estimates of the cost of buying. The last is bring the investment to the market. The conclusion of this process is an investment should be accepted if the net present value is positive and rejected if it is negative. And then we have to know how to estimate the net present value. Basically, the purpose of this is to find the difference between the present value of future cash flow and the cost of investment. There is a case in the book. Suppose we are asked to decide whether a new consumer product should be launched. Based on the projected sales and costs, we expect that the cash flow over the 5-year life of the project will be $2,000 in the first 2 years, $4,000 in the next 2, and $5,000 in the last year. But it will cost about $10,000 to begin production. We use a 10% of discount rate to evaluate new product. So what should we do here? The solution of this case is using present value. The present value formula is C divided to 1 plus rate to the power of t. And then we got the present value of the expected cash flow is $12,313, but the cost of getting those cash flow is only $10,000. So the net present value is $202,313. So based on the net present value rule, we should take on the project because it has positive value. And that is for me. Thank you for watching.
Hello, my name is Timothy Putra Anugrah and I will explain about the payback rule. So payback rule or payback period is the amount of time required for investment to generate cash flow. Basically, it is amount of time it takes to recover our initial investment. Based on the payback rule, investment is acceptable if its calculated payback period is less than some perceived numbers of years. Basically, payback rule is when we take the payback period and compare it to a cutoff that the company has give. Okay, so after that, we're gonna analyze the rule. Payback rule. In payback rule, there is no discounting involved. There is fails to consider any risk differences, and there is no objective basis for choosing the cutoff. And the shortcomings or the disadvantage of payback rule is In payback rule, it is ignored time value that may lead to tech investment that are actually worth less than cost. It is ignore cash flow beyond cutoff, and it may lead to reject profitable long-term investment. And after that, we're gonna talk about the advantage and disadvantage of payback rule. The first of the advantage is it's easy to understand. It is adjusted for uncertainty of later cash flow, and it is biased towards liquidity or short-term investment. And after that, we're gonna talk about the disadvantage. The first one is it is ignored time value of money. It is ignore cash flow after cutoff, and it is biased against long-term project like research and development and new project. Okay, after that, I'm gonna explain about the example of calculation. It shows that uh, first of all, I want to show the timeline of the cash flow like this, like in this frame. So it says that the company spent $20,000 on a machine. So it will be a negative cash flow in the year zero like this. And in year one, we're going to make uh, $12,000. In year two, we're going to make $6,000. And in year three, we're going to make $5,000. So how long it's gonna take to recover the initial investment? That's what we're looking for. We're looking for the payback period. So in year one, we make a $12,000, and in year two, we have made $6,000. So cumulatively, we have made $18,000. Up until year two, we have made $18,000. And in year three, we have made $5,000, and cumulatively speaking, we have made $23,000. So by year three, we have recovered $20,000. But we have to remember that we have recovered only $20,000, and that's in between uh, 18 and 20,000 and $23,000. So what is the payback period be then? Well, because we have recovered uh, 20 20,000 is in between year 2 and year 3, we have know that the payback period is gonna be 2 point something. But what is the actual portion gonna be? So notice up until second year, we have know that we already recovered $18,000. But the big question is how long it takes to recover $20,000 precisely. To find that value, we can use this formula right here. Okay, so how much does it left to recover to get from $18,000 to $20,000? We still need to recover $2,000, and we divide that by the next year cash flow. The next year cash flow is this $5,000. So when we divide those, we will get 0.4. So that 0.4 will goes to here. So goes to here. It will be 2.4 years to recover the initial investment, or we can say that this 2.4 is our payback period. In this case, the company says that they will only take the project that have payback less than 3 years. So notice that the payback period is 2.4 years, means that we can accept this investment. Thank you.
Thank you, Timothy, for the comprehensive presentation. Right now, I'm Aisha Rizky Paramita. I'm going to explain about the discounted payback. So what is discounted payback period? Discounted payback period is the length of time until the sum of discounted cash flow is equal to the initial investment. Based on the discounted payback rule, an investment is acceptable if its discounted payback is less than some specified numbers of years. So if discounted payback period is less than benchmark, then we're gonna accept it. If it's greater than the benchmark, then we're gonna reject it. So what is the difference between the ordinary payback versus the discounted payback? The ordinary payback, the time it takes to break even in accounting sense, and then the discounted payback is the time it takes to even in an economic or financial sense. And it's also including the time value of money. If a project ever pays back on a discounted basis, then it must have a positive NPV. So we're going to talk about a discounted payback in practice. If we use a discounted payback rule, we won't accidentally take any project with a negative estimated NPV, but it is rarely used in practice. Why? It really isn't any simpler to use than NPV. To calculate a discounted payback, you have to discount a cash flow, add them up, and compare them to the cost, just as you do with NPV. So unlike an ordinary payback, the discounted payback is not especially simple to calculate. So here's some advantages and disadvantages of the discounted payback period rule. The first of all, we're going to talk about the advantage. The first one is that includes time value of money, easy to understand, doesn't accept negative estimated NPV investments, and also bias toward liquidity. But how about the disadvantages? The first one, they may reject positive NPV investment and requires an arbitrary cutoff point. And the third one ignores cash flows beyond the cutoff date. And the last one is biased toward long-term projects such as research and development and new projects because they took such amount of time to be done. And then the example of calculating discounted payback. So let's evaluate this project. So it said that the company uses a discount rate of 10% and requires that project payback within 2 years. The two table on the left is already given in the problem. So we here going to calculate the present value, the net present value. So we here we know that present value formula is future value divided by 1 plus interest rate power up by the t, and then we got here the discounted. But in the last one, if we calculate them, it more than 39,500. So there is 7,500, which is a half of 15,000. Sorry. So it actually takes 2.5 years to pay it back because the management had required that project payback within 2 years to be accepted, and then this project should be rejected. And then here's the second example of calculating discounted payback. So consider an investment that costs $400 and pays $100 per year forever, with a 20% discount rate on this type of investment. So what is the discounted payback? So we here calculating the cash flow and it is discounted. So first of all, we're gonna divide the present value annuity factor by $400 divided by 100, which is 4, and then the interest rate is 20%. So we got here like the example before, we calculate the present value and then we got the discounted until it equal to the initial investment. So it actually take discounted payback period, which is less than 9 years.
Hi everyone, I'm Dita and I will explain about the average accounting return. So what it is an investment's average net income divided by its average book value. Some people define this as some measure of average accounting profit divided by some measure of average accounting value. But we will use the other one. It is average net income divided by average book value. Here's the example. Suppose we are deciding whether to open a store in a new shopping mall. The required investment is $500K. The store will live a 5-year life. The required investment will be 100% depreciated with a straight line over 5 years. So the depreciation is $500K divided by 5 years. It is $100K per year. and the tax rate is 25%. Here's a table contains projected revenue, expenses, and then we can calculate the net income. The average net income is 50K dollars, and the average book value is $250K. From what we calculated earlier, we can calculate the average accounting return. And we get this number, it is 20%. What does this mean? This means that if the firm has a target of accounting return of less than 20%, then this investment is acceptable. Otherwise, it isn't. From the answer, we can conclude that there is a rule. The rule is a project is acceptable if its average accounting return exceeds the target average accounting return. It's quite easy to calculate that, right? It has its own advantage and disadvantage. The advantage is it is easy to calculate and needed information will usually be available, such as the projected net income and expenses. And then the disadvantage, the first one, not a true rate of return because time value of money is ignored. And the second one uses an arbitrary benchmark cutoff rate. And the last one based on accounting value only, not cash flows and market value. So that's it for me. Thank you.
Okay, so first of all, my name is Vito, and I'm gonna explain about the problem question number 4. Okay, so let's just start the question number 1. Describe how the discounted payback period is calculated, and describe the information this measure provides about a sequence of cash flows. What is the discounted payback criterion decision rule? Okay, so the answer is the discounted payback is calculated the same as is regular payback, with the exception that each cash flow in the series is first converted to its present value. Thus, discounted payback provides a measure of financial or economic break-even because of this discounting, just as regular payback provides a measure of accounting break-even because it does not discount the cash flow. Given some predetermined cutoff for the discounted payback period, the decision rule is to accept projects whose discounted cash flows pay back because this cutoff period, and to reject all other projects. Okay, so that is the answer for number 1. And so the question number 2 is, what are the problems associated with using the discounted payback period to evaluate cash flows? Okay, so the answer is the primary disadvantage to using the discounted payback method is that it ignores all cash flows that occur after the cut-off date. Thus, biasing this criterion towards short-term projects. As a result, the method may reject projects that in fact have positive NPVs, or it may accept projects with large future cash outlays resulting in negative NPVs. In addition, the selection of a cutoff point is again an arbitrary exercise. Okay, so the last question in this problem, what conceptual advantage does the discounted payback method have other than the regular payback method? Can the discounted payback ever be longer than the regular payback? Explain. Okay, so the answer is discounted payback is an improvement on regular payback because it takes into account the time value of money. For conventional cash flows and strictly positive discount rates, the discounted payback will always be greater than the regular payback period. Okay, so that is the last question of this problem. I hope that can answer all of the question. So yeah, thank you.
Okay, so I'm Salwa and we are going to talk about problem question number 17A. The question is about comparing investment criteria. Consider the following two mutually exclusive projects, and this is the table which contain year 0 to 4 and cash flow for the project A and project B. Whichever project you choose, if any, you require a 15% return on your investment. A. If you apply the payback criterion, which investment will you choose and why? Firstly, we must remember that based on the payback rule, an investment is acceptable if its calculated payback period is less than some pre-specified number of years. So this is the answer. For the project A, the sum of the cash flow for the first 3 years is $175,000, leaving us with $175,000 to go, because the cash flow in the fourth year is for 440,000. The payback occur sometimes in the year. When we compare the 175,000, we need to the 440,000 that will be coming in. So we get $175,000 divided with 440,000. So the answer is 0.4. So payback will occur 40% of the way into year, and the payback period is thus 3.4 years. Same with the project B. The sum of cash flow for the 2 years is 46,000, leaving us with the 4,000 to go. Because the cash flow in the fourth year is 19,500, the payback occurs sometimes in that year. When we compare the 4,000, we need the 19,500 that will be coming in. So we divided the $4,000 with 19,500. So the answer is 0.2. So the payback will be occur 20% of the way into the year. The payback period is thus 2.2 years. So if we get the question, which one we will choose? We choose project B, because the investment that we will choose project B because it pays back sooner than project A.
Okay, now we have the problem question number 17b. Here is the question. Here we want to compare investment criteria. Okay, here we have two projects, project A and project B. While in project A, we have 350,000 for the initial investment, and we can see that we have return in year 1, 2, 3, 4 until we have 440,000 in return. While in cash flow B, we paid 50,000 for the initial investment, and then in year 1 we have 24,000 in return, and then in year 2 we have 22,000 in return, and until the fourth year we have 15,600. Okay, so the question here, if you apply the discounted payback criterion, which investment will you choose and why? Okay, now first we need to compute the present value of each cash flow and then determine how long it takes to pay back on a discounted basis. The rule is accept the project if it pays back on a discounted basis within the specified time. Now, we'll look at the project A. In the project A, we have 350,000 for the initial investment. In year 1, we have 350,000 minus the present value in year 1 is equal to 350,000 minus 450,000 divided by 1.15 power 1. Okay, it equals to 309,000. Okay, in year 2, we have 309,000 minus PV2, present value in year 2. It is equal to 309,000 minus 65,000 divided by 1.15 power 2. So we have the present value in year 2 is 49,000. It is equal to 259,000. Okay, now in year 3, we have 259,000 minus PVT 3. Present value in year 3. It is equal to 259,000 minus 65,000 divided by 1.15 power 3. Okay, and present value in the year 3, we have 42,000. And it is equal to 217,000. And we're looking at the year 4, in the 4th year after the investment. We have 217,000 minus the present value in year 4. Okay, and it is equal to 217 minus 443,000 divided by 1.15 power 4. It is equal to minus 34.368. Okay, and in the 4th year, the initial investment is payback. Now we're looking at project B. We have initial investment for 15,000. Okay, and then in year 1, we have 50,000 minus present value in year 1, which is present value in year 1 is equal to 220,000. Okay, so it is equal to 29,000 for the remaining cost in investment. In year 2, we have 29,130 minus present value 2. Here, the present value for the year 2 is 22,000 divided by 1.15 power 2. That is equal to 12,500. Okay, in year 3, we have 12,000 minus present value in year 3. Present value in year 3 is equal to 19,500 divided by 115 power 3. So it is equal to minus 326. We also know that in year 3, the initial investment is paid back. So we know that project B is actually give the payback sooner than in project A. But what is the exactly payback period? Now, we'll look back at the project A. We have year 3 as the last year before payback period. And now, if we want to know the discounted payback period, we're looking at in year 3, we have the remaining investment to be recovered is 217,000. So the discounted payback period is 3 plus 217,000 divided by the present value in a year in present value year 4. It is 251,500. Okay, So it is 3 plus 0.86. So it is 3.86 year. And we now already know that for project A, in 3.86 year, the initial cost to invest will be recovered. While if we look at the project B, we know that the year 2 is the last year before payback period. So the discounted payback period is 2 plus 12.495 divided by 12,821. It is 2 plus 0.97, which is 2.97 year. So for project B, in 2.70 years, the initial cost to invest will be recovered. Now we already know when the payback period exactly is, and we know that investment in project B will be paid back sooner than project A. So which investment will you choose? We will choose the investment in project B.
Hello, my name is Hanif alhaidar. At this presentation, I will discuss question number 17C. Here's the question. So there are two projects, A and B, and its cash flow and 15% return of investment. The question is, if you apply the NPV criterion, which investment will you choose? Why? Okay, the decision rules to choose the project are the general rule and mutually exclusive investment rule. General rule state that we should accept the project if net present value more than equal to 0. And the mutually exclusive investment state that we should accept the project that has the largest NPV more than equal to 0. Now we will calculate the NPV for each project. First, we will calculate the project A. The formula of net present value is present value minus initial investment, which means $350,000 for project A. And to calculate present value, we will add up all results from dividing each cash flow by 1 plus rate to the power of time. Now we will put each cash flow and year to the formula. $45,000 divided by 1 plus 15% plus 65,000 divided by 1 plus 15% to the power of 2 plus 65,000 divided by 1 plus 15% to the power of 3 plus 440,000 divided by 1 plus 15% to the power of 4, and the result is $382,589.76. So the NPV is $382,589.76 minus $350,000. So it's $32,589.76. Next, we will calculate the project B. We will do it on the same way as project A. For the present value, $24,000 divided by 1 plus 15% plus 22,000 divided by 1 plus 15% to the power of 2 plus 19,500 divided by 1 plus 15% to the power of 3 plus 14,600 divided by 1 plus 15% to the power of 4. The result is $58,673.89. So the NPV for project B is $58,673.89 minus the initial investment for project B, which means $50,000. The result is $8,673.89. So based on the mutually exclusive investment decision rule, we should take the project A because project A has a higher NPV than project B. And that brings us to the end. Thank you so much for your time and attention. Wassalamualaikum warahmatullahi wabarakatuh.